Hey there, everyone. Happy Friday and welcome to this special all mailbag edition of Chart This with Dave Keller. I'm your host, Dave Keller, coming to you today from a beautifully sunny and deliciously warm Orlando, Florida. We're here at the Money Show. Had a great day yesterday, had 4 podcast interviews. Today, I'll be going on another podcast and doing a presentation in the exhibit hall and meeting some of the attendees here today through the course of the day at different parts of the event. Thanks so much. A number of you said hello here on site at the Money Show. It's great to meet all of you and learn a little bit more about how the show is helping you and what is defining your approach to the market environment. Here in our all mailbag edition, we're going to be answering some of the questions we received during the week here on Chart This and other questions we've gotten on our YouTube comments and other places. So as always, I appreciate so much your questions. Really helps me to think about what subject areas to cover, where I want to dig a little deeper, topic ideas for a lot of different content, and helps me do shows like this where I'm able to answer questions that I've received from all of you. So with that in mind, let's get to question number 1. And at some point, I'll figure out how to show those questions on the screen, but I haven't done it yet. It's on my list. All right. Hi, Dave. Wondering if you can look at NVIDIA on the weekly chart and educate us if that's a potential double top. All right, let's look at it. So here's NVIDIA's weekly chart. And thanks so much for sending in that question. Weekly chart of NVIDIA. I'm using a 7-year weekly chart. And, just as a quick comment, a lot of the charts that I show, my default charts are 2-year daily charts and then 7-year weekly charts. And if you ask me why those are the settings that I use and why you have a different setting, it's really a preference thing, to be honest with you. I generally have, when I first started looking at charts and I was working with a lot of hedge funds and a lot of floor traders, it was much more short-term oriented. So I would look at a 6-month daily chart as kind of my default kind of long-term view. And then I would dig into hourly and 5-minute and even 1-minute charts with a lot of people looking at futures and commodities and things like that. In my Fidelity days, I kind of overcorrected way the other way. All of a sudden, I'm looking at weekly and monthly charts. I'm looking at way more data because they were long-term investors looking at secular trends. That was the sort of the time frame that we were working on. Now I've kind of come to a comfortable place in the middle. And again, the answer, the right answer for you is really something you're going to have to answer, which is, what's the right amount of time for me to have enough context and enough understanding to think about positioning with a certain outlook period. And the general rule of thumb I tell people is think about what your average investment horizon is, right? So if you're going out like a couple months or 1 month or 1 day, and then look at about 6 to 7 times that much history. That's a good starting point, right? So if you figure if you're looking like 3 months out as an average holding period, 3 times 6 is about 18. I'd start with a year and a half as a default and then do more or less from there. And you'll quickly find like, boy, there's a lot of noise and I don't need that. I want to see more detail. You make it a 1-year chart. If you're like, wow, this is not nearly enough, then you do it a 2-year chart. But that's a good starting point I found for a lot of people for what it's worth. So here's a 7-year weekly chart. And I'm looking at I'm assuming the double top you're talking about is over here. So I'm already going to say, all right, let's zoom in a little bit so we can see that in a little more detail. We'll go to like 3 years. Yeah. So here's the run higher in 2024. There's the peak. I mean, worth noting, right? NVIDIA, even though the S&P is making new all-time highs here, NVIDIA peaked in June of this year, and just now in the last week, retesting that level. So is this a big double top? And the answer is yes, it's a potential double top. And that word potential is super important. What you have to remember about any pattern like this, I tend to think of it as in 3 parts, right? You have the setup, which is it's looking like it could be a double top. And I would argue that's kind of where we're at right now. But there are 2 other kind of pieces to complete a pattern and validate a double top. The setup is one, which is it starts to look like one. That's when you can kind of tell, wait, is that a double top? The second one would be the trigger, which is what level or what move would confirm, okay, this is definitely some sort of double top pattern. So at least you have to kind of sell off and make that top, right? It's hard to say this is a double top when we're in an active uptrend. And most of the last 6 weeks, we've made a higher high than the previous week. So we're going up right now. So, there's nothing on this chart that tells me we've hit a peak here. All I can say is that we're currently going up and we're at resistance, right? You start to roll over from here. That's where I think you could say, okay, that was a peak And now let's compare the two peaks and they're pretty even. Okay, that might be a double top pattern. So some sort of pullback off of that high. And you might have a rule like you break the swing low in the middle, although with the double top pattern, I'm a little less keen on that sort of absolute rule, but that's a good starting point. So the answer is you have to kind of pull back and form that second peak. The third one, which is absolutely vital, is follow through. And that's where I would say on this kind of chart, you have to break below the midpoint, the lowest point within that double top range with a head and shoulders top. There's a neckline with a triangle pattern. There's sort of like the lower end of the triangle. Once you break through that level, you need some sort of follow through, right? Some sort of indication that, yep, that wasn't just a fluke, not just a brief thing, but it's the beginning of something more. So the answer to your question is yes, it is a potential double top. But remember, that's just the first piece of a three-part I think phases that happen in any major price pattern. I think we've only achieved one here, which would mean for me to say, yes, that's definitely a double top. You have to pull back to make that second peak and then have follow through, right? Showing signs of distribution after that. What's interesting about the weekly chart of NVIDIA, by the way, since we're here, is that the weekly MACD is very, very close to giving a buy signal. Now, the perfect buy signal for something like MACD is you're way below the zero line. This is more of a secondary, kind of buy signal. Last one we had was in January as we were breaking out of that base. So interesting to me that the last time we kind of had this pattern was when we were once again testing resistance and it broke out and it just kept going. And we're kind of right at that point. So it is a key moment for NVIDIA. Option A, do we pull back and confirm that double top, suggesting this is a major topping pattern? Or do we break out? Does the weekly PPO or MACD give a buy signal, maybe suggesting there's much further to run? This is one of those times where I think you have to be patient and wait to see which one of those plays out. It's unclear at this point which one necessarily will. Thanks so much for that question, by the way. Great question. Question number two, Dave, how does one decide when it's a good idea to take profits and when it's a good idea to let your winners run? What an awesome question. I'm going to look at the chart of CCL, Carnival Corp, not Carnival crap, Carnival Corp, cruise line. All right, all the cruise lines having a pretty decent October, sort of moving to the upside here recently, and many of them have started to break out. It's a pretty a good emerging area of strength, I would say, in the consumer discretionary sector. This idea of when you take profits and when you let your winners run is crucial. And the fact that you're asking that question, I think, is really good because it shows me that you're recognizing, I think, what the game is. The game is not being right all the time. And that's how most novice investors, kind of people just getting started, kind of expect and sort of strive to be right all the time. And if that is your goal, man, you are going to be frustrated as a trader or as an investor because you're going to be wrong a lot. And that's something you have to kind of deal with. And a lot of people never really get over that. But once you sort of get over, once you sort of recognize that you're going to be wrong, it's all about when you're right, you stay right. And when you're wrong, you admit you're wrong quickly. You limit your downside when you're wrong. You maximize your upside when you're right. And if you can continue to do that, you're in pretty good shape. Now, there are systematic ways to try to do this. I just interviewed Mike Turner yesterday for my podcast. That'll be released hopefully in the next week or so. He's a systematic investor. He's runs mutual funds and separately managed accounts and asset management firm. All based on systematic model, a very simple momentum model. He doesn't trade individual stocks. He trades the broad market at this point, but it's all rules based, right? So it's literally meant to just remain in a trade as long as possible. And then he has a set of rules that say, okay, when I see blah, 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 that means the uptrend is no longer there and I need to unwind the position and go to cash. And having some sort of rule like that, whether you outsource all of that to some systematic model or whether you have some discretionary decision around when I see these things, I'm going to exit the position. That's more something about, that's a question for you in terms of what you're comfortable with, but having some sort of exit strategy to quickly and consistently admit when you're wrong and unwind a position that is starting to hurt you is vital. So to answer so that was a long-winded way of saying I love your question, and I appreciate that's where your head is at. So what do you do with something like CCL? This is a stock that's obviously rallied off of an August low. It was bouncing off of support from the April and May lows, and now making this nice consistent pattern of higher highs and higher lows. We kind of talked about this type of look with the S&P 500, right? If you think about the chart of the S&P that I feature, at the beginning of the show, or in the chart review portion of the show, we have kind of a trend line like this. This is how I would draw the trend line for CCL. I'm basically connecting the lows from August, September, and October, and that gives me sort of a visual representation of the pace of this uptrend. And the idea is, as long as we continue this pattern of higher highs and higher lows, or to redefine, as long as we remain above that upward sloping trend line, things are good, and I probably shouldn't worry too much about it. And the good news about this sort of, what you call a trailing stop, I mean, a very simple one, but a percent stop, or some sort of way of, of staying in a trade until it comes down a certain degree. The trick is always giving yourself enough room for the natural volatility. So by waiting for a trend line here, that means we can move around quite a bit and still be overall trending higher. A lot of people kind of sell way too quickly on an initial move lower, and then they sell out, and then they miss the next like 10-20% gain because they just sold too early, and that's no fun. So what you want to do is do something that gives yourself enough room for natural volatility of the stock, but also go up. Now, I mentioned the word volatility a couple of times, and so what I just showed you with the trend line, kind of a simple way to do it. The more sophisticated way would be using something with average true range. And average true range is basically looking at the daily trading range, then using some calculation to say, if we, here's what the normal trading range of the stock, and if we do something excessive, then I want to change my position. So here's that same chart, and I'm overlaying what's called the chandelier exit system. This is a system, and oh man, it is escaping me who is the creator of this. I should totally remember this. Abe Kaufman, I want to say. It doesn't matter. I'm sorry, Abe. I think it was Abe Kaufman who created this, but it was really popularized by Dr. Alexander Elder, and he wrote a couple books. I think it was like Come Into My Trading Room, or one of those, Trading for a Living. I think it was in the New Trading for a Living. He talks about it, where he talks about this system, and really it became way more popular after Elder wrote that book. But it is a dynamic stop, trailing stop based on average true range. So the more volatile the stock, the wider the stop, which makes sense, right? If something's naturally moving a lot more, you should give yourself a little more room to account for that volatility. And so that's what this does. What's interesting about CCL is, assuming you're in at some point down here, you can see these pullbacks right to the chandelier exit, but never violates it. And so this is a system that sort of follows the trade higher. You see the same thing back here in like June, July, and then finally late July, we closed down below the chandelier exit, and that tells you, okay, the uptrend is now in question. And so some sort of system, the right answer, again, I think is up to you. There are a lot of tools that are designed to help you stay in a winning trade. And I would say, particularly if you're in something that's been working, and if you're getting nervous because it's like, okay, it's been running a lot, and now I'm concerned I'm going to, just hold on as a traders, something like this can be a great, more systematic way to recognize when the evidence is shifting against you. That's how I would think about that one. Great question. Next question, Dave, you mentioned in the recent Market Misbehavior podcast with Mark Newton that he watched the percentage of S&P 500 stocks whose price was within 20% of their 52-week high. He mentioned that 88% of S&P stocks met this metric as of the podcast. That was a couple weeks ago that I sat down with Mark virtually. So he thought because of that the rally was unsustainable. Is there a way to scan for this measure in StockCharts? There is. So two answers, right? The short answer is yes, there is. The longer answer is there's no way to chart it over time, which is what I would really love to do, but you can scan for it. So if you go to StockCharts and go to the scan engine, I actually have a scan for ETFs. Yeah, here, ETFs within 5% of a 52-week high. I'll show you what this is. It's actually a very simple scan, but hopefully just gives you the idea. This is basically just saying I want stocks, and I want only ETFs that aren't inversed or leveraged. That's what those two lines mean. So line 2 is kind of the point here. What this line is basically saying is today's high is greater than the maximum high from yesterday for the last 260 days. So over the last year, and then it's 95% of that. So I want today to be higher than 95% of yesterday's maximum high, the highest point. So what I'm basically saying is stocks within 5% of the high. Now you can change those arguments to do weekly, daily, different time frames, 3-month highs and lows, 5, 10%. So at 10%, you do 0.90. So you can use that argument to really look for any sort of thing. You can look for things within a certain percent. This is how I scan for stocks really close to the 200-day moving average. I say it's below 1% above and it's above 1% below, which means it's in that band. So it's kind of simple logic that's done. So if you use this particular statement in your scans and then tweak it for how you need, that's gonna do it. So I haven't run this here, but this is saying for the S&P, actually I'm doing a broader list, right? So that's, yeah, so hold on. So let's say S&P only. So we go down here and say S&P and add. All right, so now I'm saying this, and I'm going to say forget the ETF thing for a minute. All right, so now I'm saying just out of the S&P. So yeah, it's what, 300 out of 500, so it's just under 60% of the S&P as of this is probably as of today that I'm running this, just after the open on Friday. Are currently within 5% of their 52-week high. So if you run this sort of scan consistently, you can actually get that data. And quick hint on that one, if you on the scanning engine go to scheduled scans, that scan that we just ran, you could actually say, hey, I want to schedule this and run it every day at the close, and then send me an email. And so then you can every day get an email with how many stocks are above or below, which means you can create your own data series and chart it yourself if you want, or just have that reference list of things to look at. I really appreciated Mark's comments. Basically, I would add to that on thinking about breadth conditions and what they represent. I would say particularly when you have like the S&P at or near a new all-time high, this is a really important scan to run. We often look for things like new 52-week highs and lows. I scan for new 3-month highs and lows. Those are all things that have actually broken out. This is more saying how many things are close, right? So if the S&P is really close to its own all-time high or 52-week high, how many other things are pretty close as well? I would also point out in here, if you go to sample scan library, while I'm going through the scan engine, there are some predefined scans that are actually pretty good, right? So new highs, new lows, things outperforming or underperforming on a relative basis. There's a lot of kind of predefined scans. So if you're struggling about what other types of things you may want to scan for, that's a really good thing to really good place to start. Run the scan, save it to your login, and then you can come back to it or schedule it as you like. So that's how you can scan for that information. As I mentioned, I would love for that to be something we could chart over time. It's not a capability that is on StockCharts at the moment, but hopefully someday. All right, next question. Hi, Dave. Thoughts on using the differences histogram using weekly data as a timing tool using any of one's preferred indicators, MACD, PPO, PMO, etc. Yeah, so what you're asking about, I believe, and I brought up the chart of IBM to kind of show this. Zoom back out a little bit. So here's a chart of IBM. I have the weekly price data for the last 7 years. I have weekly RSI, and then I have weekly PPO. And the blue histogram is what you're asking about, right? So oscillator indicators like this, the PPO, the PMO, the MACD are all very similar. They're all based on smoothing out the price data using exponential moving averages. That is a basic logic of what you're doing here. And it's looking at the difference between moving averages as a way of tracking trends. This is a commonly used technique in the technical analysis world. For example, the McClellan oscillator uses this logic to create its sort of oscillator tracking changes in breadth and trying to capture short-term breadth conditions. So what is this histogram basically doing? So the way that this PPO indicator is designed and the numbers are as such. The black line is called the PPO line. And that's literally the difference between the 12 and 26-week exponential moving averages. The value of the 12-week minus the 26-week, that's what the black line represents. Then you smooth that black moving average out with the red, which is called a signal line, and that is a 9-day average of the black line. So it's literally just smoothing it out. And that's designed so that you can see as these, look for the crossovers. And basic sell signal is when the PPO line crosses down through the red signal line. A basic buy signal is when the black PPO line crosses up through the red signal line. The histogram is showing you the spread between those two. So what you will find, I think IBM is a perfect example of that. Let me zoom in a little bit more just so we can see the data here. So IBM Q1, nice uptrend into a peak right around 195 in March, and then it came down to around 160 and then rotated higher. And really for the last 6 months, it's been kind of a lights out uptrend for IBM. Strong chart. Look at what the PPO did here. And I'm going to use the inspect tool just to kind of line up the indicator with where it is on the chart. So here's where the MACD or the PPO line gave a sell signal because it broke below the red signal line, and that was right about there. And then here it gave us a buy signal. So we trading close, and then finally this week crossed above. So there's your buy signal. So that's sort of the basic signals that that occur. So look at where that was here, right? So you got a buy signal here, you had a sell signal here, and overall not bad, right? But here's the thing, right? We sold off, and then for a couple months almost, we're trending higher before the PPO line basically finally crosses, and that's because it's a trend following indicator. That's by design. It's not meant to anticipate a change. It's actually meant to confirm that something's already going up, right? So it's meant to wait until the uptrend can be validated, and then, yep, this is a valid uptrend going higher. The histogram, because it's looking at the difference between as we get closer to a buy signal, the moving averages get closer and closer. So the histogram is going down, and then the histogram starts to turn higher here in mid-May. So here's where the histogram is actually telling you this is kind of a potential bottoming point because the pace of that downtrend is slowing down, or the moving averages are starting to get closer. So there's your early warning system, and then there's your late warning, your late confirmation there when the signal, the formal buy signal finally occurs. So the idea of this is that the histogram is trying to help you anticipate when we might be getting near a buy signal. Now, I've seen people that are more aggressive in their trading strategy to trade the histogram changes and not trade those, right? So, basically looking for changes in the histogram and using that as an opportunity to fade a rally or to buy short-term weakness. Now the challenge of that is it doesn't always work. As you see in December, we pull back a little bit and then we just kind of resumed the uptrend. What some people do is use the histogram to take a partial position and then use the PPO signal to complete the position. So maybe I go half 50% long here, and I go 100% long at this point. Maybe I am short here. If you short stocks, maybe I'm short, and then when the histogram comes up, I close my short, I cover my short, and then when I get the buy signal, I go long. That's sort of how you execute based on those signals. That's why I don't recommend anything like that. Not my goal here, because I think that's really depends on you and your time frame and what you're trying to do and your goals. That's not something I can really tell you, hey, here's what you need to do. The ways that you use an indicator like this really, I think, are informed a lot more about your own risk appetite and how aggressive or how conservative you want to be. With an indicator like this, that histogram gives a more aggressive version. So, if you feel like, boy, I'm waiting way too long for the buy signals to occur, that the histogram could be a way of being a little earlier in the move. The downside of any indicator like that that's trying to be early and anticipate a move is it's going to be wrong. So as always, make sure you use good money management strategies to minimize the downside if you're wrong and maximize the upside when you're right. Folks, that's it for our special all mailbag edition. Happy Friday, happy weekend, and thanks so much for joining me here on Chart This. I appreciate you hanging with me as I do things remotely, traveling here to Orlando for the Money Show. Good to be back in Seattle for next week, and I look forward to sharing ideas and navigating these markets with all of you. We recorded a lot of great podcasts here at the Money Show. Should have 4 episodes queued up, which I'll look forward to editing up and getting out to you here over the next week or two. Some great conversations, thought-provoking, covering a lot of different topics, and I'm excited to share some of those insights with all of you. But in the meantime, have a great weekend. And for Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great one.